All right, if you care about markets at all, you need to stop scrolling for a second. Because something just happened in the silver market that doesn't show up on most screens yet, and if you blink, you're gonna miss why it matters. In the last couple of hours, silver ripped through $121 an ounce in Western markets. Not days, not weeks, hours. At the exact same time, China's trading silver north of $146. That's a $25 premium right now, in real time. And here's the part that should grab you. This isn't hype, and it's not a glitch. It's a signal. Stay with me, because I'm going to walk you through what's actually breaking, why it's breaking now, and how you can spot this kind of setup before the headlines catch up. If you're watching this right now, you're ahead of the curve. Your job is to understand what's happening so you're not reacting when everyone else finally notices. Before I explain what caused this move, let me slow it down and teach you something most people never learn about commodities. There isn't just one silver price. There's the paper price, which is what you see on futures screens, ETFs, and headlines. That's the number most people think is real. And then there's the physical price, which is what real buyers actually pay when they want metal in hand. Think of it like airline tickets versus seats on the plane. The screen can say there are seats available at one price, but when everyone shows up at the gate at once, suddenly there aren't enough seats, and the real cost jumps. That gap, that spread between what the screen says and what people actually pay, is where the truth leaks out. And when you see massive premiums in one region versus another, that's the market telling you something stressed. It's not whispering, it's shouting. If this is making sense so far, drop a comment and let me know where you're watching from, because this matters no matter where you are. So, what does that tell us right now? It tells us we're watching a disconnect happen in real time. The futures market, the paper market, is still assuming things are normal, but the physical market, where actual metal changes hands, is saying something completely different. Now here's what's actually happening, step by step. First, physical silver inventories are getting drained, not theoretically, not on spreadsheets. Real vaults are emptying. Major refiners and mints are pausing new orders because they can't source metal fast enough. When that happens, buyers don't stop buying. They start bidding higher. And that's exactly what we're seeing. Second, China's paying up. Shanghai spot prices have surged to around 139, and futures are trading even higher, over 146. That premium exists because demand is colliding with limited supply, and China's willing to pay whatever it takes to secure metal. They're not waiting. They're not negotiating. They're buying. Third, Western paper markets haven't fully repriced yet. Futures still reflect leverage, margin, and assumptions of future delivery that may not actually hold. So you get this decoupling. Physical price goes vertical. Paper price lags behind. And when those two diverge this violently, something usually snaps. Let me break down why China's premium matters so much. When you see a $25 gap between regions, that's not just a pricing quirk. That's a structural mismatch. China's industrial demand never slowed down. Solar panels, electronics, infrastructure projects, they all need silver. And they need it now, not later. So, when global inventories start running thin, China doesn't wait for prices to come down. They bid up. They secure supply. And that creates this pressure valve that eventually forces Western markets to catch up. It's like watching water find its level. It might take time, but physics doesn't care about what futures traders think should happen. Here's what confirms this isn't just a one-day spike. Industrial demand from solar alone has been climbing for years. Every solar panel needs silver. Electronics never stop needing it. Infrastructure build-outs across Asia are consuming massive amounts. Meanwhile, mine supply didn't magically increase. It stayed tight. New mines take years to develop. Existing mines are producing at capacity. So, when inventories finally hit a breaking point, the move wasn't gentle. It was violent. But here's the part that should make you nervous if you're not paying attention. Paper markets still assume metal exists that may not be deliverable at scale. Think about what that means. When confidence cracks there, when people holding paper contracts start saying, I actually want delivery, repricing doesn't happen in a straight line. It happens in steps. And those steps can be brutal. We're potentially watching the first step right now. Now let me show you what very few people are talking about. The COMEX registered inventory, the metal that's actually available for delivery, has been trending down for months. We're talking about real metal you can touch, not just numbers on a screen. When that inventory drops while open interest stays high, you've got more claims on metal than metal exists. It's musical chairs. And when the music stops, not everyone gets a seat. Zoom out for a second, because this isn't the first time silver's done this. In the late 70s, silver didn't creep higher. It coiled, then it snapped. Prices surged as physical demand overwhelmed paper claims, and premiums went absolutely crazy before futures caught up. What happened next? Silver went from around $6 in 1979 to over $50 by early 1980. The pattern was the same. Physical tightness showed up first. Premiums blew out, paper markets lagged, then everything repriced violently. In 2011, you saw a smaller version of this. Investment demand surged after the financial crisis. People wanted hard assets, inventories tightened, and silver ran from $20 to nearly $50 in less than a year. What stopped it? Margin hikes. Exchanges changed the rules mid-game. They made it more expensive to hold positions, and that killed the momentum. But the pattern was there. Physical demand led, paper followed, then policy intervened. Every time this setup appears, the pattern rhymes. It doesn't repeat exactly, but it rhymes. And right now, we're seeing that same rhythm. Physical tightness is showing up first. Check. Premiums are blowing out. Check. Paper volatility starting to follow. Check. The question isn't if the pattern's valid. The question's what happens next and how you respond to it. The larger story, when you zoom all the way out, is that sustained deficits don't resolve quietly. They resolve with repricing. Silver's been running structural deficits for years. More demand than supply. You can't do that forever without consequences. Eventually, price has to adjust to clear the market. And that adjustment, when it comes after years of deficit, tends to be sharp. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this reverse? Of course it could. Margin requirements can rise overnight. Exchanges can change rules tomorrow morning. Sentiment can swing fast, especially in commodities. And yes, some people will scream manipulation every time silver moves. They've been doing it for decades. Here's the thing though. You don't need a conspiracy to explain what you're seeing. You just need supply, demand, and constraints. Focus on what you can control. Watch inventories, watch premiums, watch delivery data. Those don't lie, even when narratives do. The mechanics are what matter. It doesn't actually matter whether someone's trying to suppress prices or pump them. What matters is whether there's enough metal to satisfy demand at current prices. Right now, the answer appears to be no. There are probably 3 types of people watching this right now. Maybe you're already exposed to silver, and you're wondering if this is the blow-off top. If that's you, your job isn't to panic. It's to manage risk. Understand that volatility works both ways. Remember why you got into the trade in the first place. Was it for a quick flip? Was it for long-term protection? Was it because you believed in the supply-demand story? Whatever your reason, that's your anchor. Don't let one day's move, even a big one, make you forget your thesis. But also, don't be stubborn. If something fundamentally changes, if inventories suddenly surge or demand craters, be willing to reassess. That's not weakness, that's smart trading. Maybe you're on the sidelines right now, feeling like you missed it. Let me be honest with you, chasing vertical candles usually ends badly. I've seen it 100 times. Someone sees a massive green candle, gets FOMO, buys the top, and then watches it come back down. Your edge doesn't come from jumping on a moving train. It comes from waiting for structure. Wait for a pullback. Wait for consolidation. Wait for a setup that makes sense with defined risk. Or just accept you missed this leg and watch for the next opportunity. There's always another trade. Always. Or maybe you're just trying to learn. You don't have a position. You're not sure what to think. You just want to understand how markets actually work so you're not blindsided next time. If that's you, pay attention to this lesson. Price alone is noise. Structure is signal. 100 people can look at the same chart and see different things. But the people who win consistently are the ones who understand what's underneath the price. They're watching inventories. They're watching premiums. They're watching delivery data. They're connecting dots. That's the skill, not predicting the future, understanding the present better than everyone else. So, here's what I want you to answer in the comments. Which one of those 3 are you? And what's your biggest question about what's happening? Because all three of you benefit from the same principle. Know what you own, know why you own it, and know what would change your mind. That's it. That's the whole game. Here's where I stand. I'm not euphoric and I'm not dismissive. I'm alert. Let me tell you what I'm personally watching. First, I'm watching physical premiums, especially in Asia, because that's where real demand is speaking. If those premiums stay elevated or go higher, that tells me the physical shortage is real and growing. If they collapse, that tells me supply's catching up or demand's weakening. Second, I'm watching vault inventories and delivery reports. That's where paper meets reality. I want to see if registered inventory keeps dropping or if it stabilizes. I want to see if delivery demands increase or stay normal. Those data points don't lie. Third, I'm watching exchange responses. Are they going to hike margins? Are they going to change contract specs? Because that's where volatility often gets amplified or suppressed. Policy matters as much as fundamentals in the short term. Based on my analysis, this move in silver wasn't random. It was structural, it was mechanical, and it was years in the making. The fundamental picture hasn't changed. It's intensified. Industrial demand's still strong, mine supplies still constrained, inventories are still tight. And now we're seeing the physical market force a repricing that the paper market's been ignoring. If history rhymes and physical markets continue leading, the move that follows could be significant. I'm not making a price prediction. I'm telling you the setup's rare, and rare setups deserve attention. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take anyone's word for anything, including mine. If you made it this far, you're the type of person who wants to understand, not just react. That mentality will serve you well. Share this with someone who needs to hear it. Subscribe if you want more analysis like this. And stay ahead of the headlines, because that's where the real edge is. Think critically, verify the data yourself, and make decisions that fit your risk, not someone else's excitement. Stay sharp out there.